Good morning, everyone, and welcome to the Macro Snapshot. We are Thursday, November the 20th, 2025. What I'd like to do today, guys, is let's just look at the data because we have the September non-farm payrolls number. Now, of course, this is quite old data. It's just going to be a question of that if it's sort of asymmetrical in the sense that if it's relatively strong, people can say that this was before the shutdown and is old news, so it doesn't really reflect the actual conditions of a strengthening or a strong economy. On the other hand, if we get weak data, will that sort of freak out the market a little bit and give rise to this idea that the unemployment situation is actually weakening? So what we have here, I'm not sure if we're actually getting an unemployment rate. The consensus is 4.3. I'm not sure if we're actually getting that here. You can see the consensus for the non-farm payrolls itself is 50,000. So let's just look at these numbers coming in. It's just 8:30 now as I'm recording this. So there we go. So we're getting 119,000. So that's definitely, as I say, this is for September. So that's a much stronger number. Unemployment rate, though, actually went up a little bit. Average hourly earnings down. So this is indicating, at least back for September, quite a strong performance. Definitely a big beat compared to the 50,000 compared, and obviously compared to before, which was a negative number. Again, this is for September. Average hourly earnings, as I say, 0.2. So that means less deflation expected was at 0.3. Beforehand was 0.4. So that'll be good news for the Fed. So we have looks like a strong employment number here with a lower average hourly earnings. So that's deflationary at the at the margin. Unemployment rate ticking up though. That's going to be interesting. There could be a question of the participation rate there. So let's just have a look here. Let's have a look. We've got government payrolls plus 22,000. Manufacturing continues to weaken. Non-farm payrolls, private actually up a little bit. So that's overall, I'd say fairly positive. The only problem there is the unemployment rate. Again, let's now just look at how some of the markets are reacting. You can see here that the dollar is substantially down. The futures are up. This is the 3-minute chart here. So you've got the S&P 500 really pushing a lot higher, liking the lower inflation and the strong number. You can see gold initially spiked downwards on the sort of a hawkish number or a strong number. And keep in mind here that this is, the idea here is that the Fed, the weaker the number, the higher the chance of the Fed possibly cutting in December. We also see here the Treasury note sort of up. Now, this is interesting here because we're seeing the US dollar down. Sorry, we're seeing the US dollar down, which would indicate a weak number, and the 10-year Treasury note up, which would indicate sort of a slightly weak number. So it looks as though the market is the Australian dollar versus the US dollar. So US dollar down on this and the Treasury note. So maybe the market is looking at the unemployment rate going up to 4.4. And we have to say that Powell has focused a lot on the unemployment rate in a lot of his sort of public comments. And the idea here is that's the one which best reflects just the balance between the supply and demand of the labor market. So that's what's going on there. Let's just see how this pans out over the next few seconds or so here. Again, on a 3-minute chart. The unambiguously for the stocks are liking that because less inflation, a lower inflation number, and maybe also that's just why the bond market liking that average hourly earnings at 0.2 and the US dollar. So that's a deflationary aspect there. So we have a higher unemployment rate, we have a lower inflation. So that's sort of on the dovish side. What I might do now is just to quickly flick over, and again, I'll put it on a 3-minute chart. Interesting to see how the 2-year bond, which is the front end of the yield, let's see how that reacts. Just because that's the one which is most sensitive to Fed policy. So you can see here quite a choppy and volatile reaction. Immediately, the algos probably went on the plus $100,000 headline number. So the algorithm's probably just taking that down a little bit. But then we got spiking up as we saw that average hourly earnings were lower than expected and that the unemployment rate was 4.4, which was higher than expected. So that would give more sort of credence to a Fed cut in December. So it's coming off its best highs here. So interesting reaction there to those numbers. So just while we're talking about data, we'll just go back onto the dailies for most of the charts here. Talking about the data, I just want to look at something. We had a revised sort of schedule from the BLS, or the Bureau of Labor Statistics. And what you can see here, if we just look at this revised schedule, let me just put it down here. You can see here that what we just got is, of course, for September. Again, we're now November the 20th. So this is, 6, 8 weeks out of, it's sort of old news in a certain sense. And certainly the market's reacting to it, though, having said that. So we're now seeing that the September data, we just got that literally a couple of seconds ago. What's going to be interesting now is that for the employment situation for October, that's actually been completely cancelled. Completely cancelled. So essentially, the BLS is saying that there wasn't enough staff to adequately carry out a correct sort of report and findings. So we're not ever going to get the October number, which is unusual. We're not going to get that. Then you say, well, okay, what about November? So now we're at November the 20th. When is that number coming out? That's actually coming out on Tuesday, October the 16th, which is actually that's after the Fed meeting. So in theory, the Fed will not use that to factor into the decision for December. And the fact that that was that October employment data was cancelled yesterday, and that the Fed the November numbers not coming out until after the Fed meets. That actually caused the front end of the curve to sell off a little yesterday, because the logic here was that without data, or even potentially weak data, there would be no justification for the Fed to cut in their upcoming December meeting. So the lack of data is not only causing a fog, but the market has interpreted that as to say that that's going to give the Fed no possibility to cut. So therefore, the chances of a cut have gone down substantially. And if we actually look at let's just look at where are we? We'll go onto the CME FedWatch tool, which we'll just bring up in a second. So CME FedWatch. You can see here that the chances of a cut in December, which were hovering around about 50%, let's have a look and see where they're at. Is that going to come up? Looks like it's just loading up here. Give me a second, or give it a second. Why is that not uploading? Um, hmm. Should I refresh that? Okay, well, it doesn't want to seem to come up. I'll just try one more time just to see if there was a temporary glitch. Let's have a look and see if that wants to upload now. Not uploading. Okay, well, we'll leave it there for the moment. But anyway, that had gone down quite a lot yesterday, based on the fact that there was not going to be sort of significant employment data. Okay, let's just have a look and see how the markets are reacting. So the US dollar continues to remain a little weak. You see the equities coming back a little bit. People probably taking a bit of a sort of a profit taking there. But what's going to be interesting, we have a small fib retracement here again on the 3-minute chart. We had strong earnings from Nvidia, as we all know. So the probably the Nasdaq's going to be up and really liking that. The stocks, things like the semiconductors index, are going to be very strong. What is interesting, just in terms of the overall sort of stock market, though, is, as I said, we had Nvidia blew out all of the metrics, which we won't go into all the details, but very strong sort of earnings, forward guidance, et cetera, et cetera. So that looks to be strong. And some people are saying that that means that there's no AI bubble. But you have to say that what is good for Nvidia means that the other hyperscalers are spending a lot of money. And so the real question is going to be whether they continue to overspend. But at this point, the market is taking that as a positive. And now we have this, relatively supportive sort of non-farm payrolls for September. And we had Walmart. Now, Walmart was just released earlier this morning, and Walmart was quite good. Sort of overall metrics, like the sales were good, the forward guidance was good. But something which was quite interesting is that on the call and on the guidance, they highlighted that people there seemed to be, again, this whole idea of the K-shaped economy, that people continue to spend quite strongly and no real change on basics, but on the bigger ticket items, they had seen, on the discretionary items and on the bigger ticket items, they had seen a reduction. So it's like people are sort of shifting their money into basics and are still, happy to spend on those, but they do seem to be cutting back a little bit on the discretionary items. So again, interesting here, you see gold continues to pump higher, and actually the bonds continue to pump higher. So the market is obviously focused, as I say, on the unemployment rate of 0.2, and also the unemployment rate going up to 4.4, which is higher than expected, and the average hourly earnings. So quite interesting there, because definitely we have a sort of a dovish reaction in terms of the US dollar. Okay, so just going back to some other things, we had the FOMC minutes yesterday. And no surprise there, but maybe it's going to be interesting just to look at some of the comments. And if we just look at some of the comments here, I've just did a few screenshots of some of the comments. One thing I just want to sort of also have a look at here is just so we all understand that the quantitative words used in the FOMC minutes, and this was actually a document put out by the Fed themselves a few years ago. And this is sort of the hierarchy of numerical values or the saying quantitative words. So all means, 100%, I guess, one or another. And you can see here just the little nuance or almost all or generally, most, majority. And so many is more than some, and some is more than several, and several is more than a few. So just keep that in mind when we actually look at some of the comments. You can see here, for example, several participants assess that a further lowering of the target rate could well be appropriate. So several, as we know, is less than many. Many participants suggested, though, it would be appropriate to keep the target rate unchanged for the rest of the year. So it's almost like a little bit sort of balance towards people doing unchanged. And if we actually look again, just at some of the comments here, um, sorry, I just want to look at some of the comments here. Let me make this a little bit bigger just so we can do it. Um, yeah, so they're saying that in a very gradual cooling of labor market conditions, further policy rate reduction, so a cut, could add to the risk of higher inflation becoming entrenched. So they're worried about higher inflation becoming entrenched, or from a political and sort of credibility point of view, or could be interpreted as implying a lack of policymaker commitment to the 2% inflation objective. So it's interesting that the Fed also seems to be worried about their credibility with the market and perhaps even with the general public. So they're worried that it could be implying a lack of policy making commitment. So this is again slightly hawkish, saying that the balance of risks are that they do nothing. And just see if we have some other comments here, which maybe we already saw. Um, yeah, there's some participants commented on stretch asset valuations, with several saying that there was a possibility of a disorderly fall in equity prices, so a dramatic fall in or a non-justified fall in equity prices, especially in the event of an abrupt reassessment of the possibility of AI-related technology. So it's interesting that the FOMC committee is actually talking about the AI situation and that, there's a potential for a bubble, or at least what they're calling in more diplomatic language, a reassessment of of that kind of technology. And that's interesting. There's also a couple of participants cited risks associated with a high level of corporate borrowing. So again, this idea that we got great Nvidia earnings yesterday, but remember, what's good for Nvidia means that everyone else, all the big hyperscalers, are borrowing a huge amount of money. And the question is going to be whether they're going to get a return on that investment. Maybe they'll get a few extra billion dollars income every year. But on the other hand, a lot of these companies like Meta, talking about spending 50, 60, 70, 80 billion dollars on capital expenditures every year. And it's interesting that the Fed seems to be looking at that. Just looking at a couple of other comments here. Let's have a look. Uh, yeah, many participants judged that the effect of overall inflation of this year's higher tariffs would likely be limited. So that's interesting that they're saying that, possibly this whole idea that the tariffs would be sort of a one-off and, indeed limited. That's interesting there about the effect of tariffs there. Um, what else? Just having a quick look here, guys. Um, yeah. So overall, I'd say just looking at at these comments, and that's just a summary of a lot of the comments there. It seems that the chances of the Fed not cutting, they would require clear evidence that the labor market was weakening. And what we've just seen, just to go back, what we've just seen, at least from the September numbers, again, it's old data, but at least from the September numbers, definitely it just seems to be telling us that. That's not the case. So let's just have another look here. As I say, the unemployment rate up to 4.4. The Fed will not like that. So that's evidence maybe to cut if you're that way inclined. And the average hourly earnings 0.2, down from 0.3 and well under the previous of 0.4. So that's pretty good news for the Fed here. So that's interesting. Let's just see if that Fed Watch thing actually eventually did upload. Oh, it did finally upload. So again, this is my point that if we look at the December meeting, a pretty incredible change. If you look at the comparison here, you can see that 1 month ago, almost basically 98% chance of a cut. And look how that's come down. That's a week ago, that's yesterday, and here we are today at only 27%. So that's come down from almost 100% chance of a cut down to 27% chance of a cut, so only 1 in 4 chance of a cut. And I think with this employment report, my personal view is that probably that doesn't give the Fed enough ammunition to cut. And as I say, we're not going to get October, and November is going to be after the Fed. So that's interesting now that it looks as though a Fed cut is, a much lower probability. Although, of course, we do get up more data over the next couple of weeks. So, maybe if that data is uniformly weak, that could cause the Fed to change their mind. Okay, so let's now just also look. I just want to have a quick look here, guys. Some of the other markets, see what's been going on. There's been a lot of talk about Japanese yields. I showed that yesterday, and just sort of interesting here. If we just put that up, you can see that trend. Is this the right one? I think this is the right one here. Yeah, you can see that that continues to sort of go higher. I mean, it come off a little bit in the last couple of hours, but we reached up to 3.4%. And the reason I just want to sort of look at this, something I just want to show you is that it's all about the hedging. And I came up with a interesting sort of chart here, which I dug out. Where are we? I think I had that. Yeah, so this is kind of interesting. And first of all, I just want to look at the things about the Japan and the yen, because we also know that the yen is also been ripping higher. And before we just look at that chart, let's just refresh our memories and actually look at the yen itself. So we see that the yields are going up a lot on the long end on the 30-year. And if we actually look at the Japanese yen versus the US dollar, so this is USD JPY. So you can see here that this is ripped high, continues to rip high, US dollar pushing up, although as we just saw, US dollar having a little bit of weakness there based on those payroll numbers. But you can see here that the USD JPY, it looks as though it could go get all the way up here to 158.9, 159, let's call it 159 up there. Maybe that's got to be more like intervention territory or even a bit higher than that. Now, why am I saying that? Just because technically that is where we could go to. It's not to say that the BOJ or the Ministry of Finance may not intervene right now. Because one of the things we do know is that they do like to intervene on US dollar weakness. And if you say that the US dollar slightly weak, just literally now, maybe this is a good moment for them to start selling some US dollars. We shall see over the next hour or two if that happens. But I just want to, this is just when they have intervened before. And it's interesting, this is now a little bit old, it's from yesterday. So you see this number now is a little bit higher. But you can see that going back in time, the most recent one, you can see that the level of intervention, the high of that week, has actually been in the 160s, 161. So people talking about intervention now at 157, 158, this would actually, be a lot lower than when they've recently intervened. So it's important to keep in mind that the most recent interventions going back to last year, 2024, was actually almost at 162. And then if you go back to the previous, it was at 16, just over 160. So we still have, 100 or 200 pips to go. So let's not get too excited. You can see here the amount of money they actually sold. And this is also what's very important is the so-called Kanda rule, who used to be the official over there. There's now a new person. The point here is that month low to high. So this is essentially how many sort of handles, so to speak. So let's say 152 to 155 would be three. Okay, that's like 151, 52, 53, 54. That would be like a three handle. So the point is that really what they need, they're worried also about the speed of change. Okay, so you can see here that in the past, over the last month, where they started to intervene is really when we're getting 3, 6, 7, quite significant and fast moves. They do not like fast moves. They're not necessarily against, the yen weakening, but they don't like volatility and fast moves. And you can see here that the 4-week change, you're looking at least, around about 1% or so. And then also interesting is normally after the 52-week high, around about 2.5%. So interesting table here. And you see the current situation here tells us what's going on. So, the main thing talking about intervention is not so much the level. Definitely the 4-week change is interesting. For sure there is chances of an intervention, but I would say we need to go a little bit higher. As I say, that level maybe about 159, 160, we could see a bit of action. Now, what I was talking about the yields, of course, the problem here is that in Japan, the incoming administration of Takeichi, basically I think it's about a 17 trillion yen stimulus package they're talking about. I think in US dollars that's over. I have to do the maths. I think it's about 120 billion US dollars. So this is higher than the market had been expected, and so a significant stimulus package. And there's a concern now that with inflation still a bit sticky, and this stimulus package, that's going to lead to further issuance, and that's what's causing this. Sort of a melt up, so to speak, on the long end yield. So more issuance means the market has to accept more bonds or absorb more bonds, and of course the price goes down, pushing up the yield. The market demands a higher coupon to accept those. And the point is, what we're trying to say here as well is that in terms of the hedging costs, and this is just interesting, giving you a sense of, if the yields at home in Japan continue to go into that 3.5, maybe 3.6 level, that becomes more attractive for Japanese investors to get out of their overseas or their foreign sort of investments, repatriate the money, which could cause the Japanese yen to rise. And why would they do that? And it's just interesting. If you look here, this is from yesterday. This is hedging costs. So if you actually look here, this is a weighted average of euro bond investment premiums at FX hedge on the 10-year. So the key point to make here is that you see this number here. It's a bit hard to read, but it's about minus what was it, about minus 8 or so, about minus 8 0.8%. That is actually what you get if you're in the eurozone, if you're hedged, if you're buying US 10-year bonds. Minus, it's a negative return. Of course, if you don't decide to hedge and you're at the mercy of the fluctuations in the FX values, okay. But you see here that actually, you see how it's gone down. It's now negative. So there's the negative zero. So you see at a certain point, it was positive. If you go back, 2024 and whatnot, but you can see now it's actually negative. Okay. Now, what about our Japanese investors? This is for Japan, even worse. Now, look at this, 1.2% negative, 1.2% negative. So the point is here that in Japan, you can get unhedged, on a 30-year bond, about 3.5%. But if you're buying, let's say, a 10-year, and again, these are numbers for the 10-year. If you're buying a 10-year US Treasury, by the time you hedge it out, because remember the front of the curve was steep, so hedging costs were quite high in the US, you're getting a negative return. So the point is there that is making it less and less attractive for Japanese investors. Well, it's just I'm saying it's not attractive for Japanese investors to have to be holding Japanese U.S. Treasuries. Now, I'm not saying that everyone's going to suddenly sell U.S. Treasuries, of course, but the point is that at the margin, incrementally, a few basis points, a percent here or two, certain Japanese life investors may be saying, maybe it's time to come back. Interesting. Anyway, let's keep an eye on all of that. But the basic point here is that USD JPY very, very, very strong. Let's just look at a couple of other things finally before we close this off. Just let's catch up with the shorter term. Okay, so you can see here the US dollar. Look at that coming back quite a lot. That's why it's tricky to trade these data releases. You see that coming back almost to P level one or price level one. The release looks as though it's trading a bit heavy. Equities, you see it had a little fib retracement here pushing high. Definitely a clear winner for equities here. Gold's not quite sure, mixed data, and the treasury yields, or the treasury itself has come down, so the yields went lower and then have come back up. So again, that's probably reflecting that mixed bag of the data, the fact that the unemployment rate was higher than expected, indicating a softening market. But on the other hand, the actual number itself was plus 100,000, which was well above expectations. On the other hand, inflation 0.2 in terms of the average hourly earnings was good. So interesting here. It does look as though the US dollar is trading a little on the heavy side. Although if we actually look at the chart for the dollar index, you can see here that it's at a pretty critical level. And as I say, it has been in a nice little sort of, grinding upward trend since, this sort of double bottom retest at the 16th of September. But this is a key overhead resistance here. You can see this resistance level here, a lot of resistance here. Now, will there be stops here? Probably. And could this sort of push through the measured move, which I've got here, going from this latest impulse? It does measure out a little bit higher, but certainly this level where we're at now at 100.3. Again, 100, bit of a key round number there. So no surprise that maybe the dollar wants to pause a little bit. Doesn't mean it's going to collapse or anything, but maybe just pausing a little bit. before, if it wants to sort of have a bit more of an upward run. One thing is interesting just to cross pair. So I was looking at some data yesterday. Generally, when Nvidia has a positive result, the Aussie JPY has a positive sort of movement. And now we saw that Nvidia did move over 5%. And we can see here that the Australian dollar versus the JPY, classic sort of risk on one of the more reliable sort of instruments to trade if you're getting sort of a positive move in some of these semiconductor, the big tech companies. And that's being borne out today. See Aussie and JPY pushing a lot higher. Also, of course, some weakness in the Japanese yen itself, of course. Okay, guys, I'm just going to leave it there. One thing I did want to have a quick look at just before I finish was just on oil. Oil's interesting. You can look at this in a couple of different ways here and say that, well, it's weak price action. Now, if we put on sort of moving averages and whatnot, which I'll just throw on, let's say some, let me put these on here. I mean, I'll put on the EMA, so the 20, 50, 100, and 200. And, it's relatively sideways. So what's interesting is that if you look at this, you could say, oh, on this big downtrend, it was sort of, rejected and then rejected and then rejected. So that's a negative. And you could also say that it's not really getting much higher and it's finding it difficult to break out. On the other hand, you could say that, this is sort of, it was a bit of sort of a bull flag situation and it failed. That was a geopolitical event as well, though. We could also say that, the Russians and the Americans seem to be working behind the scenes on some kind of deal potentially in Ukraine, although we have further clarity on that this morning, that the Russians are saying that there are contacts but not consultations. So obviously people are talking, but it's not yet at the level, it seems, of formal consultations and a deal or anything like that. And of course, obviously Europe and Ukraine haven't been invited to the table. So the point is here that oil is moving a little bit on that and pushing up just a little bit this morning on the fact that, any so-called deal between the Russians and the Americans is still a long way off, and certainly a ceasefire is still a long way off, and a peace is a long way off. So oil just grinding up a little bit. But it is interesting to me that oil is not collapsing. It does seem to have found a little bit of support around about this, 59.5 level. Any positive news here about the global economy or trade, tariffs, et cetera, et cetera, could cause oil to have a little bit of a pop higher because it's a little bit of dead money at the moment, but it is sort of holding in there. So that's just something interesting to keep an eye on. Okay, guys, I've spoken too long. I'll leave it there. Let's just see how the market shakes out today. Again, it's interesting that pre-market Walmart actually was down a little bit, even though the earnings were relatively strong, just on this notion that people are cutting back on, sort of luxury and discretionary items, and they're, just happy to spend still on the basics and the essentials, but cutting back a little bit on some of those discretionary items. So we may see in things like the retailers like Walmart and whatnot down a little bit today. But of course, the semiconductors and Nvidia, in theory, presumably Nvidia is going to have a bit of a strong day. So the tech, so we could see some rotation as well today. Okay, I'll leave it there. Have a great day, and we'll be back tomorrow. Thank you.